Well, all right. Here we go. So, I do a lot of videos and I saw this live feature on YouTube and I thought, why not just try to go live? And a lot of times on my Q&As, I'm really not editing them anyway. So if you check out my channel, there's all kinds of Q&A videos. I do a how-do series and I've got a couple topics on there. If you have any topics you'd like me to discuss, I'd love to do that for you as well. I have a podcast that we do as well called Clear to Close. So I put that on my channel, a bunch of stuff there. I'm just trying to grow the page, trying to get better at how this microphones and editing and just trying to get better at this. I really enjoy what I do for a living and want to answer any questions anybody has about mortgage financing. I do lending in the state of Utah and Nevada. Most of my career has been in Utah. I got my Nevada license a little while ago and had my license for a while and then dropped it because you have to have a physical location in Nevada and we lost that location. So I had to drop my license for a while. Then we got it back. So got my Nevada license back, which is great. So I'm working on expanding my market share to Nevada as well. I'm in southern Utah, which is just outside of Nevada, Arizona, right on the border of southwest Utah. It's called St. George, Utah. Love this place. Moved here in '05. It's an incredible place to live. But let's see if we can get some questions going here. So I do have a few that I want to start with. And let's see, am I learning how this whole live thing works? So sorry, I'm stumbling through this a little bit. Okay. One of the questions I saw in here that I thought was pretty good is how far back do mortgage lenders look? So there's a couple things we look at. If it's a major derogatory on the credit report, like a bankruptcy or foreclosure, those can go back further depending on the loan program. Most of them go at least 2 years. Some will go 3, 4, and then 7. So it depends on what it is. They also really will look the last 2 years on employment and residential history. So they want to see where you've worked and lived over the last 2 years. And why that's significant is, let's say your job is a lot of overtime or bonus or commission. If you don't have that 2-year history, they typically won't count that income. Now, you can have it from a previous employer and switch. There's some rules when it comes to that. But if you're new to an industry or you haven't been on a commission or bonus or overtime schedule, they typically won't let us use that income. They'll just use whatever's the base pay. Same with self-employed. If you're self-employed, they want to see 2 years worth of tax returns to show what you've actually claimed as taxable income. So this question here is, how far back do mortgage lenders look? It depends on what we're looking at. Credit history can go back 7, 10 years, depending on what it is. Job history, residential history is typically 2 years is what they're going to look at. The credit report is whatever's in that credit report. They're really going to look at the last 12 months of any kind of lates that you have. And then when you start getting derogatory like bankruptcies, foreclosures, that's when they have longer waiting periods from the end of that event, from a Chapter 7 or a Chapter 13. Let's see. Let's see. Okay. In wholesale real estate, what happens when you can't find a buyer in time? Well, when you wholesale a property, I'm without knowing more context on this, but generally how I view that question is, when somebody is a wholesaler, this is where they go out, find a property, put it under contract, and then assign that contract to somebody else. Sometimes they don't close on it. So it sounds like that's what happens here. What happens when you can't find a buyer in time? You lose your earnest money typically. You can run into the risk of maybe a seller suing you or something like that for breach of contract. So you want to be careful how the contract is written. But a lot of times that earnest money deposit is what's at risk if you don't fulfill your end of the contract as a buyer. So in most cases, you'll lose your earnest money deposit. Let's see. Oh, I love this question. I have this question with a lot of people all the time, and it's phrased a couple different ways, but here's how the question reads. Do I own a home if I have a mortgage? Of course you own it. You have the ownership right. You can sell it. You can refinance. You can do what you want with the home. There's nobody, no mortgage company is going to show up and say, oh, I don't like that color of paint you put in your living room. You got to take that down. Or I don't like the carpet you're doing. I don't like the remodeling you're doing. You can't have pets. So just because there's a loan and it's collateralized, and that's basically what you're using to get your mortgage, that's the collateral, doesn't mean you lose ownership in the home. The mortgage company doesn't own your home. They just have interest in the property as a lien that if you don't make your payments, they have something they can take back. They have collateral, but it's not like it changes the ownership of the home. So I have a lot of people say, well, if you have a mortgage, then you don't really, the bank owns my car, the bank owns my house because I have a mortgage. No, they don't. What what constitutes ownership is who has the right to use it, to sell it, to refinance it, to change it. You can change the landscaping, you can change the remodeling of it, all that type of stuff. So you own a home. The mortgage just helps you own it. The mortgage helps you own it. It doesn't take away your ownership. So yes, you own a home even if you have a mortgage. All right, so let's see. Do we have any questions on the chat? Not yet. I'm again just learning how this all works. Just thought I would jump on and see how this live thing works. I'm still getting new to having a channel and all that kind of stuff. So if you have any questions, anybody popping on, ask a question here. Otherwise, I'll just keep reading some questions that I got fed through the internet here. Why did the Fed raise interest rates before the price of real estate exploded? That's just giving way too much credit to what the Fed can control. The Fed's not going to control home prices. If anything, they're trying to watch inflation. They're trying to control interest rates that are short term. Mortgage rates are tied to a different index anyway. Now, obviously, if the Fed raises the rate, that's an overall indication where the economy is going. The cost of funds are going up, so that will change what mortgage rates are, and that's why they lowered rates to try to help offset some of the things that were happening. But home prices went up simply because supply and demand. That just supply went way down, demand went way up, and the prices went way up. That's really, it had way more to do with than any Fed policy up to that point. All right, let's see what else we got. If anybody's on the chat, go ahead and put a question in. Let's find another question here. Can you get a mortgage for a investment home with a FHA loan? Short answer, no. FHA loans, VA loans are designed for primary residences only. Now, you can use it to purchase the home and then turn the home into investment property. That usually has to be 6 months to a year after you own it. But no, you can't use an FHA loan to purchase an investment property. It can be converted, you can switch it, but you can't use it to initially buy the home. Let's see. Make sure I keep the chat open here if anybody has any questions. Kind of fun. I mean, I'm new to this, so hey, let's give it a try. So ask a mortgage nerd. That's what this is all about. I've been doing home loans since 1999. Love what I do for a living. Really love in real estate investing. I have a bunch of rental properties. I do fix and flips, private money financing. I've been doing this so long. I tell people often I sell money. I sell money for real estate, and that's really what I try to do. But I really have fun educating people. And I often say, you'll hear in a lot of my other videos, that you're not supposed to know how all this stuff works. That's why you have me, to help you walk through an application, walk through a pre-approval, go through organizing all the pieces that come together to buy a home, from a home inspector to an appraiser, the title company, homeowners insurance, all that stuff, home warranty, all that stuff is what I help you walk through from the start to the finish. That's what I help people do. Let's see. Does getting a cosigner help you get a mortgage? Depends on the cosigner. So if your credit scores, they always go off the lowest credit score of any borrower on the file. So if the cosigner's credit score is lower than yours, then they'll go off that score. If the cosigner has way more debt and doesn't bring any positive income to the table, then it doesn't really help you to have a cosigner. So just adding another name doesn't automatically make the loan more approvable. They still have to go through the same qualification that you would to buy the home. So let's say you have a high debt ratio and you bring somebody that has a mortgage and 2 cars and student loans and all that, and they're not positive. They don't have the positive to offset your negative. The cosigner's not helping you. But I did a loan one time with 6 borrowers on it, and it gets a lot of moving parts when you do it that way. I mean, typically it's a husband and a wife, maybe a brother and a brother, or, there might be some investments type stuff like that. But usually I'd say most often it's going to be 2 borrowers, but I had one with 6 that was just crazy. But adding a cosigner can help depending on the qualification of the cosigner. But just because you add a cosigner doesn't automatically make you approved, because now there's 2 people on the loan, 2 people on the hook. That helps to have another borrower on there. But as long as they're bringing positive income, assets, or credit score to the table, they're not really helping you on a cosign situation. Also, here's something to consider as well. If you're co-signing, if you're a parent co-signing for a child, you are obligated on that loan just like your son or daughter is. So if they miss the payment, that shows up on your credit as well. And you can't get off the loan until you refinance the property. So there's some more of a long-term situation when you co-sign with a family member. So it is something to be aware of that. One other little trick you can do here as well. Let's say, and I've done a lot of these loans where you've got a son or daughter that has no income, no assets, just starting out, buying a home, maybe go to school, go to college, or just starting out. You can co-sign as a parent, and it's still a primary residence for your son or daughter. So they're the primary, you're in kind of helping them, and it becomes a non-occupant co-borrower. So you get the better rates and terms than if you just buy it yourself and rent it to your child. I had a loan where the client didn't even have a credit score, didn't have any down payment, didn't have a job. The parents completely qualified on their own, but got the better rates and terms by having at least the son or daughter on the loan as their primary residence, kind of an extension of your primary residence. That's a, I wouldn't call it a loophole. It's just a guideline that many people don't realize. I see so many parents buy a house for the kids and let them rent it. So it's an investment for the parents, but they miss out on the better rates and terms. Maybe they have to put more money down than if one of the kids can at least be on the loan and they're actually living in the property as a primary residence. I've done a ton of that for college towns where the kids want to, maybe build some credit up, build some equity. They're going to be renting or something anyway, and the parents have the funds to help them with the down payment. So they end up just trying to buy it as an investment, but they have investment property interest rates. So there's a way you can do it with having the son or daughter at least be on the loan. Now, if their credit's bad, not lack of credit. If they have a zero credit score because they really don't have any loans, that's okay. But if they have bad credit because they've already missed credit card payments or have done something like that, then that situation may not work as well. But that's something to consider. So you need help with that. I lend in Utah, Nevada. So if you're looking to do that type of loan or any type of mortgage financing, I'd love to help you. Our company, Synergy One Lending, is licensed in many states. So if you need help in other states, we can help there too. But I'm specifically licensed in Utah and Nevada. All right, what else we got here? How much time? I like to keep these to maybe 20 minutes on my other show. So let's see how long we want to keep this live going. But if you have any questions, comments, go ahead and chat. Jump on in and ask a mortgage nerd. Oh boy. All right. Is there a way to pay my mortgage off in 5 to 7 years? Yeah, pay extra. Pay the balance faster. Just like any other loan, the more extra you put on principal, you're paying it off that much faster. So that's the best way to pay off a mortgage is pay more to it. Here's what I would say about that. I've done a lot of debt counseling with people. I'm working on becoming a budget coach as well. That's one of the things I want to add to my arsenal of tools to be able to help people. I really love helping people with the money situation because it just causes so much stress in a marriage and life. And just like anything else, if you're not tracking where the money's going, if you're not assigning a value to each of your dollars, it is so easy for it to go somewhere else. We live in a society where every commercial is got the lighting and the music to take your money, and they're very good at it. They're good at making everything a lifestyle experience, and you have to have it now. And you're going to miss out if you don't buy XYZ, a car, or even a hamburger at this point. But I look at the psychology behind marketing and media is way stronger than any kind of willpower. So if you have some systems in place and budgets in place, you'll protect yourself from yourself of falling into the traps of where the money goes. That you got to get the newest iPhone or you got to get the newest whatever. I'm amazed at how many people rely on willpower or don't budget, where if you start working a system, you'll be in a much better situation. So the question again is there a way to pay off a mortgage in 5 to 7 years? Here's what I would say to that. Yes, paying extra obviously helps round up the payment when you can, but here's what I would say to do first. Pay off other debts first because they're typically going to be higher rate. They're typically going to free up more cash flow to where you can then put bigger amounts towards the mortgage. And mortgages are tax deductible. You're going to have usually a lower payment for the amount you're financing, where $100 on the car loan will go a lot further than $100 extra on the mortgage. And even a step before that, get at least $1,000 in an emergency savings, no matter what. Make sure that's something that can cover deductibles, emergency, have that somewhere separate from your day to day. Then start paying down other debts, then build up more of a reserve or more savings, then start tackling the mortgage. I really think that the way I've always run the numbers, everything I'm doing, just money can go further on the smaller debts, get them closed, get them paid off, and roll. They call it the snowball method. Roll it to the next debt. It'll go so much further. Plus, you'll feel like you're getting some ground. Throwing an extra $500 at a mortgage won't feel like you're getting anywhere. It won't build up any momentum. But putting $500 more towards the car or a visa or other debts, then that debt, the minimum payment plus the extra now rolls to the next debt, and eventually you're putting a bunch towards the mortgage. That makes a lot more sense. So build an emergency fund first, pay off the debts with the smallest balance first so you can get some momentum, then build up a 6 months reserve of income and assets. You want to have 6 months left over. Then I would start tackling the mortgage. All right, let's see how we doing on time. Okay. All right, we'll keep going. Maybe I'll do a few more here. If you have any questions, please throw them in the comments and we'll get to them right away. Let's see. What is the consequence of paying off a defaulted loan? It's not really a consequence for it. If anything, it'll help your score by your credit by getting that kind of resolved. You'll be able to work with that lender again. So I think it never hurts to try to work out what debts that have defaulted or settled or judged. So there's really no consequences for it. If anything, it's a good thing. Do we always buy? What? Do you always buy things on sale or only when they're truly a good deal? Well, everything's on sale. So again, we talked about marketing a little bit. Everything's on sale. Everything's last second. Every inventory reduction sale. Well, what happens when you sell something? You reduce your inventory. So a lot of it's marketing. A lot of it's just marketing. Yeah, for me, when I look at buy things, it's really a need versus want. I always kind of classify is this a need or a want? And I try to maximize everything I buy. I try to keep it working properly. I try to take care of it so it lasts a little bit longer. But I don't just buy it because it's on sale or a good deal. Usually it's a need or a want, that kind of thing. And then try to find the best deal, obviously, that I can. I don't know why that's in this section. That's interesting. All right, well, whatever. What was the subprime mortgage crisis and what caused it? Sorry. What was the subprime mortgage crisis and what caused it? So this was back in '08 is when it all really hit the fan. So a subprime mortgage is a loan that didn't fit conforming or conventional guidelines. So these were loans for people with lower credit scores, maybe higher debt ratios, less money down. So mortgages like Fannie and Freddie backed mortgages are what we call conventional loans or prime loans. These are loans that fit the market, that was securitized. These were loans that were just known as prime loans. So loans that didn't fit that box for debt ratio, credit score, time on the job, down payment, whatever didn't fit those prime boxes started falling into these subprime and alternate A. They used to call them alt A for loans that didn't quite fit those boxes, but were good everywhere else. So maybe you had somebody that was self-employed for 10 years, wrote everything off, didn't really claim all the income, whatever, because he was self-employed, had great credit scores, money down, all the other things checked the box, but all of a sudden income verification didn't. So they started coming up with stated income loans or limited doc loans or different ways to help those types of borrowers. What happened with the subprime crisis is that got abused. As more and more of those loans started falling out of boxes, they kept coming up with other programs that would fit the need because home prices were accelerating like crazy. Everybody felt that it was never going to slow down, started drinking their own Kool-Aid, so to speak, and Wall Street started buying up these mortgage-backed securities like crazy and asking for more. They were just like, hey, give us more of these. Give us more of these. What loans are you turning away and why are you turning them away? So it got to the point where it was just nuts. There's a joke that you could fog a mirror and get a home loan. There was stated income, no asset, no application. The applications I saw were just blank. You literally just had to have a pulse and they would give you a home loan. And sometimes they do it at 100%. No money down, 500 credit score. So as those programs got abused, the subprime market finally blew up when home prices stopped accelerating and these people that really couldn't afford the home started missing payments on these huge waves. That's when they just hit the fan. Just everything hit the fan when these programs that really had a need, the subprime loan, the alternate A loan, when it first started, fit a need. There was little gaps in what was available in the market. These were trying to fit those gaps and they just got abused. And so instead of tweaking the stated income loan program, they threw the whole thing out. They came up with all kinds of rules and regulation that happened after that really restricted the type of loans we could do and all kinds of different things. So a lot of ways they threw the baby out with the bathwater, I think, in some of these programs because some of them still make sense, but they just got abused. That's really what the subprime crisis was, just abusing of the mortgage market and the people that were running it, frankly. All right, let's see how we doing on time here. I lived through that whole thing. I've been doing loans since '99. Boy, it was a crazy time. It really is. And This current environment we're dealing with is much more of a supply and demand issue than bad lending practices. And that's why I don't see there's going to be major crash. Now, is there going to be correction? Sure. Slowdown, most likely a slowdown. I don't see a crash. I definitely see things slowing down. And real estate's very local. You're going to see pockets where things are going to be different, where foreclosures are going to go up in some areas, down in other areas. But it is something where this isn't the same crisis that we saw during that mortgage meltdown, mortgage crisis of 2008. All right, let's see. How we doing on time? Sorry. Let's see. We got anybody on the chat yet? Okay. This is the first time I've done a live on YouTube, so I don't know. I don't know what happens after this. So I guess when we end it might just go into my channel. I've got a lot of videos on there. If you have any comments of other videos, post, share, like, whatever. I'd love to help you with that. And I really do enjoy what I do for a living. So I'm just trying to share my expertise and maybe have a little fun, be a little nerdy, hence the name. All right, let's see. How can lenders lose when they keep down payments and repossess collateral upon foreclosure? They normally don't. The mortgage crisis of '08 was because they loaned too much. They were 100% financing and properties got upside down. But when there's and the funny thing is they don't keep down payments. So that's, you're not giving your down payment to the lender, you're giving it to the seller, but you're lowering the risk of the lender and yourself by putting 5 or 10 or 15% down. So the lender doesn't keep your down payment. The buyer, the seller gets the down payment and they get the money from the lender. So for instance, $400,000, you put $50,000 down, you do a loan at 350. The seller gets the 400,000. 350 is a loan, 50,000 is your down payment. So it's not like the lender is getting the down payment. It's the seller getting the down payment. But that being said, when you start a foreclosure process, it's not like it's right after you miss the first payment. It can be 90 days, 120 days of you missing payments that you're not making your payment on, that now the lender has to start just kind of waiting to get their investment back. Then they have to go in foreclosure. Then there's waiting periods for that. I mean, it can be a year from the time you start kind of missing payments to the time when they actually get the home back. Then it has to go into the secondary market, wholesale market, or to an investor. Usually foreclosures don't get kept up as well. The buyer's not going to, the client's not going to maintain the home nearly as well if he's just losing it anyway. So usually the condition of the home goes down. So there's usually a chance that they will just try to get their money back in many cases, but they'll be losing interest during the whole time. They can't reloan that money anytime. So they just have to sit on that property until they can sell it. So there's time and expenses that they have to just eat or wait until they sell it. And if the market does go down to the point where they can't get their investment back, or the quality of the home goes down, or something like that, they do run the risk of losing money on the investment. Now, it's rare. I mean, that's why mortgage rates are so low. They securitize them with a bunch of others to spread that risk out. Certain loan programs are designed to minimize that. Then you throw in mortgage insurance. That will help offset some of the risk or some of the loss the lender can receive. But how do they lose? There's lots of ways that mortgage companies can still lose on loaning a property. That's why there's still rate and interest and risk and stuff like that. It's lower risk, sure. It's a lot lower than a car loan. It's lower than, say a title loan or a check payday loan. That's why those rates are so much higher. So interest rates are designed to offset some of the risk a lender is taking, but there's still risk on loaning on real estate. So yeah, how do lenders lose? Usually it has something to do with loaning too much, or the value goes down dramatically, or it takes too long to get somebody out. The condition of the home goes way down. That's how lenders can still lose on real estate. All right. Check another box here. All right. Well, this is fun. I mean, a little different, huh? A little different vibe. I hope you like what we're talking about. Ask any questions in the chat here. Maybe I'll jump on and do a couple more of these lives. Usually I'll just record a video like on Canva and then just post it. I usually don't do a lot of editing to it. I just kind of just talk. So there's sometimes I screw up reading the question or don't give the answer that actually matches the question. I remember reading one of mine that after I got done, I read the question. I'm like, ooh, that's not what the question said. Still was good information. Just didn't exactly answer the question, but all right. Let's see. What are the benefits and drawbacks of investing in equity or debt in commercial real estate? So whether it's commercial or residential, there's going to be benefits and disadvantages of investing, whether it's cash flowing, whether it's maintaining the property, whether there's downtime of between having somebody renting the property and then having to go in and fix it up or get it ready for another tenant. So commercial is a little different animal when it comes to real estate type stuff, but um, there's always going to be benefits and disadvantages in real estate. I'm a big believer in real estate. It's a little more of a long game. There's little pluses and minuses when it comes to that type of, everybody wants to be in and out, whether it's crypto or stocks or other type of investment type things. They're a little more short term, where real estate does have a tendency to be a little bit more long term. You got these fix and flip type scenarios where people go in and fix them and going to make all this money. And then there's other times it's a buy and hold where you're going to turn it into a rental property. But I'm a big believer in real estate. I've done it for a long time. I really enjoy the fix and flip. I really enjoy having rental properties. There's just a lot of things that you learn from doing it. Surround yourself with the right people, get the right real estate agent, get the right mortgage company, right title company. It's important to build a team that can help you if you're going to get into this real estate investing world. And I would say if you're going to do rental, the biggest tip I can give on rentals is screen, screen, screen. It's so much easier to say no to the first 5 people that knock on the door than it is to get rid of a bad renter. And check their credit. If you can't, you've got to check the credit. You've got to check some referrals. I mean, get a list of places they've worked or lived or anything, and call up and see how they were. They're going to tell you. They'll be happy to tell you if you got a bad renter on your hands. And as soon as you start seeing stuff where they have to borrow money for security deposits or first month's rent or something like that, that's a major red flag. And they'll have sob stories and horrible things. I mean, it's a business. You've got to treat it that way first. And it's so much easier to wait to find the right renter than it is to have to kick one out. That's horrible. That's way worse. So screen, 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 say no. I'm amazed at how often that first person that shows up is looks the most excited. They're putting on the best story, the best face they possibly can. And you're, oh, great, I got it rented. I don't have to worry about it. Boom, I'm just going to get it rented. Where that one always seems to be the worst one. I always have the most problems on renting to that first panicked borrower that shows up that wants to rent it. So screen, take some time, do the background checks, wait to see what else pops up, who else pops up, but just take a little bit of time. Now that doesn't mean something won't happen. 6 months down the road, the person loses their job, has a medical problem. It can turn bad when it comes to that type of thing. But I'm amazed at how much you'll save by just pre-screening at the beginning. All right, how we doing on time? Let's go one more here. Oh, let's see. If you have any questions, go ahead and jump on the chat. More questions are coming in here. Just gotta find the right button here and skip some of this other stuff. Let's see if we can do a mortgage topic. Let's see. How do I skip a mortgage payment with Wells Fargo? Normally you don't. Now, sometimes you'll see maybe promotions where they'll offer a skip payment, but generally mortgages don't do the skip payment for the holidays. Like you'll see a credit union on a car loan or maybe a Visa or something like that will offer you a skipped payment. You don't see that very often on mortgages. You really don't see a skipped payment. But you do, if you need to skip a payment, if there's a problem where you are going to be missing a payment, definitely reach out to your lender. They may have a forbearance or a modification or something where they'll may be able to work with you on that. It's far better than just missing it and just hoping they don't care. It's much better to reach out. But you don't see this skip a mortgage, skip a car loan, skip a payment in mortgages as much as you maybe do on more consumer type debt. Let's see. Would you co-sign for a friend or family member if it would help them get a mortgage? That's a tough one because you're mixing family, friend with business, and that always turns south, unfortunately. The other thing is once you co-sign, you're on the hook for that loan just as much as they are. So if they start missing payments, it affects your credit. It affects your ability to go get your own home loan. So if you've got a buddy's loan and you have to qualify for that debt, you also have to, it may limit your ability to get other credit or other mortgages down the road. So yeah, I wouldn't say no in every situation, but I'd lean towards no in most. Most situations, I would say don't if you can avoid it. If you do it, just realize it is a business thing, have everything laid out. You want to get notifications if there's any lates, you want to get statement or username and passwords. You want to make sure you have access to the account to make sure that if it does go past late or something like that, you're getting notified so you can reach out and say, hey, what's going on? If you are co-signing for a family member, you're going to have a little savings for that property, just an emergency fund. You say, okay, they don't miss a payment, their payment's $1,500, whatever it is, $2,000, have that aside and make sure you have that ready in case all of a sudden they don't make a mortgage payment. So I'm not going to say every single co-sign is a bad deal, but I'm going to say I've seen it turn worse more often than it turns a good thing, whether it's mispayments, miscommunication, the property doesn't get taken care of, you go to sell it, there's a dispute there because the person's like, well, I've been making the payment the whole time, I get all the equity. And you're like, well, I've been co-signing. And so you just want to lay some of that stuff out. What happens if they don't make a payment? What happens if you decide to sell the property? What happens if you need to refinance it so you can go buy a house? If you've already got your house situation, you're a parent or something like that, and you're trying to help a kid, that can be a little bit different. But I've seen situations where a year after they do the cosign, the friend needs to get off the loan, but the original friend still can't qualify and can't get you off the loan. So you want an exit strategy is what I'm trying to get to, whether that's selling the home in a couple of years or if they need to get out of school and their income will go up so they can qualify on their own, something like that. But you're really tying your finances with friendship and family, and that usually a lot of times that will have problems down the road. So just lay everything out. What happens if they don't make a payment and make it as clear as possible. Write it down. Make a contract. Don't just handshake. Don't just he said, she said. Write it all down. I've seen so many friendships and families get blown up over money things, especially with home loans, whether it's a mispayment or not. Like I said, just whether you go to sell, what happens when you go to sell? Who gets what percentage of the equity? Is it a split? 80, 20, 50, 10, or, 10, 10, 80, 20, or 0, 0. He gets all of it, you get nothing, or, so just have that all laid out. That will really help you. All right. How are we doing on time? We're, boy, 31 minutes. Okay. Let's do one more. We'll call it a night. How about that? There's a lot of cosigner questions. What's the best way to get a mortgage without a cosigner? Just qualifying, having the income and assets to qualify. It depends on why you need a cosigner too. Do you need it for down payment? Do you need it for debt ratio? Do you need it for credit score? It depends on why you need a cosigner, but generally qualify for what you qualify on your own. Let's see. What is the difference between a conforming loan and an FHA loan? This might take a little time, but here we go. So a conforming loan is loans that are underwritten and guideline through Fannie Mae and Freddie Mac. These are two of the big mortgage lenders that securitize mortgage-backed securities, and they set the guidelines that many, many lenders follow, that if it fits within those two companies' guidelines, they're very similar. They have little nuances, but they're what we call conforming or conventional loans. FHA loans are government-backed loans that have private mortgage insurance that is paid through the funding fees they collect on FHA loans. So really, they're both mortgages. They're not any different when it comes to mortgages. They just have different guidelines to fit different needs within the marketplace. Like an FHA loan will go lower credit scores typically, usually lower money down than the conventional loans. The big one is definitely FHA is used more for first-time home buyers with maybe lower credit scores, lower down payment, less time on the job. So it kind of falls in guidelines that the conforming loans just won't do. So conforming or conventional loans usually are a little bit better, a little more of an A type of client with credit score, down payment, debt ratios, those types of things. They're a little more strict on, so they require a little bit more of an A, B kind of client, where FHA is a little more lenient. I wouldn't say they do B and C loans. I'm not trying to say that. They're just more lenient in some of the areas that the conventional loans are not. And FHA loans are insured by the FHA program. So really, FHA doesn't loan the money. They set the guidelines that we as lenders follow, and then they provide the insurance, the mortgage insurance, that if that loan defaults after we follow their guidelines. So the loans are still funded in the name of the company. That just FHA is really a mortgage insurance company. That's really what they do. They collect fees on the front end. They collect a monthly insurance fee that goes into a big fund that covers losses when loans go into foreclosure. So they're just different guidelines between those two. They both have benefits and disadvantages. I'm not going to tell you that FHA is the perfect loan for everybody. Conventional loan is not the perfect loan for everybody. So they both have a different need in the market they're trying to fill, and they have different guidelines to fit their risk and their need within that marketplace. So hope this was entertaining. Hope anybody has any questions. Check out my website at ryanbolton.com. I loan in the state of Utah and Nevada, and would love an opportunity to work with you if you're trying to buy a home, refinance a home. I've been doing home loans since 1999, and I really do love what I do for a living. It's the problem solving, the answering questions, the kind of figuring stuff out. It's got all these guidelines that we try to fit clients into and try to figure out the guideline. It's fun. I've been doing this for a long time, and it can be stressful, just like any other job. It can be stressful with deadlines and meeting and appraisals don't come in. And I mean, this is a big purchase. Buying a home is a big time deal, but working with the right people will make it so much better. It'll make it smoother. It'll make it as fun as it can be. I mean, I think going to the dentist is still way worse than getting a mortgage loan, but some people think getting a mortgage is worse than that. You must have had a horrible experience with a mortgage company, or you must have a great dentist. Anyway, hope you enjoyed the video. Like, click subscribe, check out my other videos. I'm trying to add content all the time. If you have any topics, love to have your topics, and maybe I'll post another live here in the next little bit. But have a wonderful day, and hope to see you again. Thanks.